Okay, good afternoon, everybody. Today is Friday, October 21st. This is the weekly Take on the Market. I will be your host. My name is Scott St. Clair. I am the manager of the Premium Product Group here at Investors Business Daily. Please take a moment to read the disclaimer. I'm not licensed. Nobody at IBD is licensed that I'm aware of. We don't make buy, sell, hold recommendations. Our circle of competence is education, research. Hopefully you guys are learning to do this on your own. Okay, so the routine is the same. You know the drill. We'll do the indices. We will go through some charts, some stuff that I find through the week that I'm reading, whether it's on Twitter or newsletters, things that I find interesting. The industry groups and stocks to watch, and then the quote. So always the same. Makes it easy for me. It helps me get in a groove and just kind of give you guys some food for thought for the weekend before you do your work. And one last thing, it is 11:45 my time. So the market is open. I have some things, so I can't do this afternoon when the market's closed. I usually prefer, obviously, to let the market close because just in case. Today is a key day. On Friday, the market's very strong today. So unfortunately, it's either now or never. So you got to take what you can get sometimes. So I just wanted to throw that out there, especially when you see some of the charts. Okay, so here is the chart of the NASDAQ. And so far today, up 1 and change, almost 2%. So if the volume comes in, this would be a follow through day. So this is day 1, day 2, day 3, day 4, day 5, day 6, day 7. So it'd be a day 7 follow through day. So what does that mean? Does that mean you go from 0% invested to 100? Not in my book, not if you're doing this correctly, but you probably want to put on some risk, especially if you've been bearish, negative, been in protection mode. If you don't have anything long, I think you put on some risk. 5% position, 10% position, just get some feedback from the market. It might not work. There's a chance it doesn't work, but there is a chance it does work. And if it does work, you want to be starting to position and get yourself some feedback from stocks. I have, this is probably the most bullish I've been in a long, long time. I'm not an uber bull, but I'm a lot less bearish than I have been. We have been in a really long bear market, and they have torched most stocks. Adobe, Intel, great companies down 50%. Semi-okay companies, probably super overvalued in hindsight, probably not even in hindsight. Shopify, PayPal, Coupa Software, Atlassian, Zoom, and go on, all down 50, 60, 70% off their highs. So the indexes have done a massively good job of hiding the real overall damage. Now, my fear is that means that the indices need another leg down, possibly. But I'll cross that bridge if we come to it. So let's go to the S&P. So day 1, right here, the S&P is up more than the NASDAQ. And that's the theme, I think, too. I still am negative to avoid. Like if I was a Wall Street analyst, I guess it'd be an avoid on Apple, Google, Tesla. I'm still short Tesla, even though I think the market's going to rally. I have a token short position. I've covered most of it, but I don't want to get completely out of it. And then act as a counterbalance. Gives me good feedback. When I'm losing in Tesla, it tells me that when I say losing, I mean for the day, right? I can see in my account that Tesla is, of all the positions I have, it's the one that is negative. So it gives me good feedback. All my longs are up and my short is down. What more do I need to see, at least at this very, very moment? So I think there are voids, the Amazon void, they, based on history, are going to go sideways for a long, long time if this is the bottom. Does that not mean you can't make 10, 12, 15% in them or something? Sure. I just think that it's just going to be a much harder grind in some of those names. Been bullish on energy and that type of and materials and I think Dennis Gartman coined the term things you drop your foot on. I remember I'm going to give him credit for that just in case it is him. That's the type of stuff that I like here. The companies that are making stuff that you could drop your on your foot. MDB, those types of software stocks. I don't know. I think the game is over there. But I'm flexible and open, and I am very, very often wrong. But this is how my thesis right now, and right now the market is proving my thesis correctly. These are the best relative strength stocks. Some of them are making highs that they haven't made in a long, long time. So I want the market to prove my thesis rather than the other way around. So here's the S&P. For what it's worth, Vanguard Value Line ETF, you can see how much stronger it is than the indexes. We've never used this for a fall through day, but you can see it's only down 13% off the 52-week high. So held up a lot better than, let's go to SPY, 22%, QQQ, 32%. And, just for a reference, K-Web, which is Chinese kind of QQQ, 60%, ARC, 71%. So the market has gradually, slowly, and then very quickly gotten out of those types of names, and the money has to go somewhere. And I know we talked about the bond market being really bad, so it goes somewhere. So I guess maybe some of it goes to money heaven. It just evaporates in the stock market, but some of that money is left, and it goes somewhere. And there's lots of AUM, assets under management, that have to be invested. If I was in a mutual fund manager and I had to be fully invested, and I didn't have a mandate, like I wasn't running, the Fidelity, software stock portfolio. Let's just say I had an overall mutual fund with just a make money strategy. I would have been dumping all the Microsofts and Intels and Apples and Googles and Teslas of the world and pushing it into these other names. And I'll show you some of the things that have held up the best. That's how I would have been playing it, slowly but surely, if you had to be invested. And I think a lot of them are, because that you're seeing that with the relative strength. Let's TLT, which is the proxy for the bond market, down 40%. This looks pretty climactic to me, which is one of the reasons why I'm semi-bullish. Is I feel like the move down is long in the tooth. You've got a gap down here finally. You have a tiny bit of a reversal, and the yen reversed today too. Hopefully my camera, let me turn my camera off because I hope it's not covering that. But this is an ETF that I had been trading. You can see it's a pretty bad break, right? If this was a stock, that looks like it's hit a wall. It doesn't mean it's over, but at least short term, it's hit a wall. All right, so indices wise, I think there's a chance we get a follow through day. What does that mean? If you do something, I think is probably what it means. You probably want to be long one name if you're not long already. So these are the number of 1% down days. And you can see the huge spike that 2022 has had. S&P down days to end the week, from 1952 to 2022. And I want to give credit where credit's due. Bespoke. I'm 99% is who I got this chart from. And you can see the huge spike in the number of days where the S&P is down 1% or more. This is a very interesting chart, B of A Global Fund Manager Survey. And you can see that their allocation to equities is like 08 lows, 08, 09. So the guys and gals that are running the money are nervous and bearish, or nervous if they have to be fully long. But they haven't, the money inflows haven't capitulated. See, that lighter blue line is still above the zero line. So it's very strange dynamics where the people running the money are nervous and bearish. And the people that are giving them the money, you know, they've come off the highs a little bit, but they haven't reached that kind of capitulation phase. So I thought that was very interesting chart right there, because there's a lot of talk about, you know, how much bearishness is out there, and that's I get that, but that's why I like a chart. Like, show me that there's a bunch of bearishness out there. Show me the proof. You know, Missouri, you know, the show me state. Show me that people are bearish. How are they bearish? The surveys and stuff are fine, but that one is, you know, the people that are actually running the money. Liquidity is a problem. I don't know if you guys have seen it, but it's hard to get in and out of some stocks, at least at the price you see, right? The price you see is not the price you're going to get for a lot of stocks. So it's pretty bad. People are pulling bids. There's not that much liquidity out there. It's kind of a problem. And then, you know, government bonds have been this straw that stirs the drink this year. It's an epic poor year for government bonds, kind of across the globe. But, you know, just focused here at home, it's been pretty bad. And then last but not least, I think I've talked about this before, the 60-40 portfolio is just, look, historic. Probably never have something like that again, at least in my lifetime. But it's, you know, worse than, I think this blue bar over here on the left is like 1929. So worse than that. And you see how long we went, where a 60-40 portfolio was just did such a good job because of the balance, right? Even in 08, you didn't even lose double digits because bonds went up. They offset the losses almost, but yeah, between the interest you receive and the bonds actually going up in 08, it helped to offset the losses you'd experienced in stocks. No such balance this year. It's been a bloodbath in that regard. Okay. Well, last chart, and this is from the Daily Shot, which is a really cool newsletter. Lots of charts they give, and it's the Goldman Sachs IPO basket and the Renaissance IPO ETF, and it's been game over for IPOs. It's the one thing that, you know, it's going to take some time for IPOs to come back. The nice thing is, I think the next wave of IPOs will be quality companies, because they're going to be a little bit more diligent in what they bring public after this experience. Because a lot of the IPOs, gosh, some of the names I was buying, like Path, it's like they're going away. It's like they're going out of business. I don't know about Path specifically, but I mean, like in general, some of these stocks are trading like they're going out of business. And these were all the IPOs in the last couple of years. So we need new merchandise, the new and can slim. I can't remember the last time we've been talked about an IPO, got excited about IPO, but they'll come back. And my gut instinct is the quality of them will be much better. And so there'll be some, you know, potential really good companies in the years to come for us to invest in. All right, let's go to the industry groups. And we won't spend too much time on these because I think it's almost pretty much the same. Oil and gas royalty, energy, solar, transportation, oil and gas, oil and gas, oil and gas, oil and gas, oil and gas machinery. So, it's littered with these ones. And, some people might say that if the market comes back, maybe they go back to their old favorites and get out of some of these things that have shown really good relative strength. That's a possibility. I think it's highly unlikely, but I have to consider that is not totally out of the question. The odds of that are not zero. So build that into your model. That's why we have stop loss rules and sell rules and things like that. But I've talked about it previously, the percentage of energy in the S&P now versus historic averages, and also versus, well, I want to say telecom, but that's not the right word. If, software / networking / technology is a broad overview. It's a seesaw, almost always a seesaw back and forth based on history. So I feel like it's, 25% over here and 4% in energy. Even if it went to the median, it could double. It's not going to double overnight, but it double over a number of years. So, it seems like that's where maybe we get the new potential wave. It's not my favorite, right? It's hard for me to know why to buy Schlumberger versus National Oil NOV versus Tidewater. Why should I buy DINO, Sinclair versus Valero? I don't know. It's hard to tell why one or the other might be the leader. So, in this instance, I tend to buy a lot more of them and sprinkle it around and just let the market kind of pick the ones versus, earnings and sales and margins and things like that for software and semis and stuff. I think it's not easy, but easier, at least the way I like to, select stocks. But these have provided a great gains so far this year, and the charts look like they're working on the next leg up. So we'll ride that until it ends. All right, so stocks to watch. I have a list of just a ton of things that I was interested in, I think are important here. I'm going to turn my camera off just so you can see the charts better. I think this is something to watch just because big money. I don't want to get into the macro dynamics of why the yen matters, but it matters, and big money watches it. And so if they watch it, then I want to watch it. And this has been, look at when it started to broke out of this huge base. That is March of 22. Let's look at the NASDAQ in March of 22. So right here, the top of this rally, right? So something's dynamically happening, the liquidity is being drained out, and that's kind of what's going on there. So I watched this. I actually traded this year. You can see how it kind of, just kind of stair-stepped, and it's a currency, so it'll kind of move and then sit there. But if I still had this, and I don't anymore, I sold this somewhere here, somewhere there. It's a little bit early as usual, but that's okay. The kind of day like this would bother me. That looks like a sell to me. So if that's a sell, then I have to think, the other way. So, but I was talking about the damage. Let's look at just very briefly the damage in Intel. Intel's a great company, right? But not a great stock. How about Taiwan Semi? Down 56%. How about Adobe? Oops. Down 56%. How about Netflix? I don't think it's as good a company as those other ones. but even after this huge rally, it's down 58%. And so, you know, they've hit everything. It's, you know, Amazon down 37%, and even, you know, the stalwart Apple down 20, and then can't forget Tesla down in half. Now, a lot of people will tell you, well, it's up big. Great. And I'm envious of the people that can buy it down here, and hold it through all the wiggles all the way up. It's great. The problem with that is you're gonna have to have a big winner like this, to buy something at 30 split adjusted and ride it to 212. You're gonna have to ignore a lot of sell signals. So, you know, these reversals like this and like this and like this and like this and like this, maybe if it comes back, you just have numerous sell signals, and it's hard to know when to get out. Nvidia, another great example, down 50, oh my gosh, 64%. So it's just hard to do, and especially if you're going to do it in size. You want to have a 1% position in Facebook or Tesla or Apple or Google. You can just leave it and you know, try to let it turn into a 8 or 9 or 10% position if you catch a 10 bagger or something like that. I just don't see how you could possibly do it with a 10, 12, 15% position, not for the whole move. Maybe you can capture it in bite-sized morsels. So you buy Nvidia here and you sell it there, and you buy it there and you get stopped out, and then you buy it there, and then you sell into strength, or you sell it there and you break even. But, you know, it's no fun. You had a break even, a loser, but you caught, you know, a 60% ride here. From here, that's probably be the amount, about the same thing. So this is about 70, and now the stock's 123. So it's maybe a little bit more, 80% or so, but you've avoided all that carnage. So with the theme that we've had a really bad bear market, it's possible that this could be the low. I know somebody asked me about the waves down. I guess we can talk about that. And, you know, you can interpret this a number of ways, but, you know, I would say this is wave one, you rally. This is wave two, you rally, and this is wave three. So you have 1, 2, 3 lows, 3 waves down. Bill talks about a lot in his books. Maybe that's possible. Some markets have had 4 waves down or 5 waves down. You go back to 2000, it probably had a number of waves down. So it doesn't have to stop on 3 waves down, but the idea behind 3 waves is that you've really kind of wore them out, right? So if you had stock and it came down here and then it rallied, your feeling is, oh, I think I've survived the pullback. And then it undercuts those lows and goes way down here, and then it rallies, and it's like, oh, whew, I don't know how I did that, but I somehow survived the lows. And then it comes back down and undercuts the lows again. And usually it's like, I just can't take it anymore. You get that kind of capitulation, which everybody was looking for, but we never seemed to get. So as far as stocks, Schlumberger breaking out of a base, PBR. I don't own Schlumberger. I do own PBR breaking out of a base. Valero, not really breaking out, but a lot of times I like to manufacture a buy point, and I think that was the buy point. So that's where I bought that, breaking out there. EOG breaking out. COP, another one that I've been in. Tried there, stopped out, tried again, works so far anyways. And it's just, they're all energy. Tidewater, you know, it's up. What bear market? It's up 22% this week. So a lot of people are looking in the wrong spots because they've been trained to look for the you know, the great stories, the MDBs of the world. It's a great story. Coupa, it's a great story. What else? Team, an amazing company. It's just not a great stock anymore. And you own the stock. You don't own the company. What else is there out there in this area that's acting good. If you're looking for ETFs and you just, Scott, I can't buy individual stocks, I'm tired of them. Well, then there's EWZ. This looks like huge big double bottom. Let's go to monthly. Just done nothing for a long time. But look at the relative strength. Look at that. It's 93. It's really starting to outperform the S&P because the S&P is going down and this one's sitting there. I don't know how accurate or the yield is based on, going forward, but I have owned PBR before, which is in this, and do own PBR, and probably got the biggest dividend of my life on that name recently. It's not that it was all that big. It's just I'd never really been in any dividend paying stocks before. So that'd be if it went up and you caught a little bit of a yield, that'd be great. So this name looks interesting to me. I do own this as well as PBR. I like the exposure that this has, that Brazil has, to things that you can drop on your foot, right? Versus the QQQs, which is, Amazon and Apple and Google and all fantastic companies. They've it's built into the price. I think the world is shifting, but I need the market to tell me I'm right versus me telling the market I'm right. So as long as it's doing that, it's going up, then I say, oh, okay, maybe I'm right. And I've tried EWZ a couple of times. I can't remember if it was in here. I think so. No, in fact, it was there. I had a precedent for it. It reminded me of the 0809 low in our US market, where it grinds up higher and then runs into the 40-week line and sits there. And it worked for 2.5 weeks, and then it rolled over, and I had to get out. So a lot of my best trades take 2 or 3 times before I get it right. I don't know. I'd be curious how often of the great trades that I have actually work the very first time. So I'm gonna have no problem going back to them 2-3 times. Within a short period of time, that 4th time, I'm probably not going back. I'm probably going to give up on, if it's within like let's say a 3 or 9 month window. I'm probably not going back a 4th time. Something's either the stock has my number or I'm misinterpreting the price action. And then I know I did mention VTV. So this is another option if you wanted to put on exposure, but I'm nervous, Scott. Okay, it's a value fund. Might not make as much if you get it right, but hopefully you can get some feedback. If this market's going to rally, maybe you get some feedback from something like this. If you're wrong, you can get out. You can stop yourself out of a huge Vanguard value ETF. On the tech side, there was one name that's interesting to me, ASML. I know it's not the right way that we like to buy, but you've got the 1, 2, 3 waves down. This is really, I love this company in this area. It was, trades in the Netherlands, Dutch company. They really are the leader in semiconductor equipment, and the equipment that makes the semis. Their fundamentals have just been off the charts. Now it's not as good. They're in a slowdown, but you can see previously the quality of their fundamental. Look at the return on equity and the EPS rating. But the semis have just gotten smashed. SMH, which is a proxy for semis. Remember, I talked about Intel, and I didn't even talk about AMD, down 64%. So, they've had their bear market. Can it be a worse bear market, right? The average stock goes down in a bear market 72% based on the studies. That's the average. That means some go down 60 and some go down 80. We've had some go down 80, the Teladocs and Carvanas of the world. So 60% seems, right in line with a pretty nasty bear market. So this is an index that's down 40 some percent. So this one is interesting to me. And, you had earnings and they weren't all that great, and the market and the stock didn't go down. It's that type of feedback that I like. I like that when the news is bad and they don't go down. I often, or the other way around, if the news is good and they stop going up, that's a sell signal to me. So I might find a way to wiggle myself into this name as well. I don't know what the right buy point is. I've thought about it for the last 5 days, and every day it's up $10. No, it is a $450 stock. So it's not like it's running away, but um, this would be a good proxy for me as far as am I wrong on technology not leading? That's why I'm interested in this name as well. I think it would give me good if I own this and it starts to work. Maybe I ought to be more open to owning some of those technology stocks. So this is one that I'm considering. So I have a bunch of energy stocks and EWZ, which has mining exposure, and I do have the one short Tesla. I don't know. I don't know why I don't want to cover Tesla, even though I think the market's going up. I did get a lot of congratulatory messages on Tesla when it gapped down on the earnings. So that was the contrarian in me didn't like that. I appreciate the messages, but I just thought, that's not a good sign. I liked when everybody thought I was crazy to short Tesla, and most of the time they were right. You're crazy to short Tesla. So most of the time in the last few years, they have been right. But I want people to tell me I'm crazy, that, I would never go short that, or and then you had a lot of good news, on the conference call, and the stock still went down. So if I lose on this, or if I give up some of my gains, that's fine. I think that will be more than offset by my long exposure, because for the first time in a long time that I can remember, my long exposure is higher than my short exposure, much higher. I think this might be the highest long exposure I've had in a while. Let's see what happens. All right. Let's go to the quote of the week. Louis Vincent Gov. He's I don't know if Gov Kyle Research is like a newsletter, or but he was on a podcast, and he said bear markets change leadership, which is something Bill's harped on for years and years and years. It's true. They change leadership almost always. That's another purpose of bear markets, is what he said. One of the purposes is to, it's wipe the slate clean of undisciplined and investors and things like that, which I think this market has done a fantastic job of doing. I don't know if you saw the Journal article about Schwab's trading volume is drastically down from the craziness of 2020. I can't wait to read the history books on 2020. It's going to read a lot like the history books in 2000, I think. It's just a lot of things that people are going to say, wow, why were people doing that? That seems obviously irrational. But we do that as humans. So that's one of the other, but the day trading phenomenon, people at home from the pandemic and, buying YOLOing options, that game is over. It's not coming back, at least not for a long, long, long time. It will recycle as new people come into the market. That's kind of why these once in a lifetime bear markets, I think, usually occur kind of every 10, 12, 15, there's a cycle of years for when they come around. So you had at least for me, 2000 to 2003, and that was after an 18-year bull market run. Now there were some stops and starts. It's never in a straight line. 87 crash, gosh, that must have been terrible to be if you got caught in that. And then the Asian crisis, the Russian devaluation, the long-term capital thing, that was in the 98, 99, 97, 98 period. That was really bad. That took stocks down a lot. But then the big bear market occurred after that. And then you run up for 8 or 9 years, and you get a whole new wave of people. And then it's a different reason. In that case, first it was technology stocks were overvalued. Then it became real estate and banks. And now in this one, I guess it's it's bonds, it's, you know, debt. It was kind of a straw that stirred the drink to the downside on this one, but it occurred, you know, 09 to 22. You had some fits and starts in there. You had the 2016. It was a bear market, I think. It was short, but it was a bear market. And then you had the 2020 COVID one, which was quick but nasty. If you got caught in that, the stocks went down a lot in a hurry on that one. And now, so you have a 13-year window or so to this one. So that's kind of what happens. It just continues to cycle as new investors come into the game and other guys, you know, move on. Bear markets are not fun, but they're there for a reason. Transition from one group of leaders to the next. So it's our job, your job, my job is to find that new leadership. And it's the hard thing about the follow through day. It's kind of the one thing about the follow through day that we can't quantify. The follow through day is very math based, but that's the science. The art part is, okay, where's the leadership? And the smart money, the guys I know that do this really well, they don't get all that excited about the follow through day, the actual follow through day. It's great that there's a follow through day. They get excited about stocks with good earnings and sales, or good setups, or good groups breaking out of basis. And the Chipotle in 2010 is a perfect example. All the managers at William O'Neill in September 2010 were buying Chipotle, breaking out of that cup with handle, had all the characteristics. It was on the follow through day, but that's just because the stock happened to move on that follow through day. If it was the day before the follow through day or the day after, they'd have been doing the same thing for sure. It just was, the setup was just too strong. So look for the next group of leaders. That's your job. And this weekend is the first time you can kind of get excited about it, I think, and look around and at least in a long time and dig in and make a watch list just in case that this one works. I don't know if it's going to work or not. Nobody knows. Nobody knows. But there's a chance. I don't care how bearish you are. You cannot tell me with a straight face that there's 0% chance this works. If you do, I think you're making a mistake. And the other way, I'm not 100% certain it's going to work either. So I'm somewhere between a 0 and 100. I'm a little higher than 50 on this one for the first time since this bear market started. All the other rallies I was super skeptical on, just because I just didn't see the setups. But this looks like there might be a couple of setups, and maybe that's a better sign for this market. We'll know in a couple of weeks. All right, everyone. Thank you. Have a great weekend. No take on the market next week. Thursday, my colleagues Arnie and Harold will do the stay in step. I am on vacation out of town for the weekend, so there won't be any take on the market next week. I'll be back the following week. Marcus Smith at investors.com, 800-424-9033. Thank you, guys. Do some work this weekend, especially if you haven't been. I know most of you are, but maybe some of you can get lazy. I can. Guilty. Not doing as much work as I probably should, because you just kind of know there's not that much out there. So grind it out this weekend. See you later.